Good afternoon, everyone, and welcome to another episode of the Dairy Signal. We're so excited that you've joined us here on this first day of May 2025. Not quite sure where the year has gone, but we're so happy that you're here for a market update with Mr. Ben Buckner, Chief Grains and Dairy Analyst with Ag Resource Company. Looking forward to the discussion today, Ben. I want to remind everyone to take advantage of Slido, which is, if you're viewing on a desktop, it is to the right of your screen. And if you're on a mobile device, just scroll past the little video here and you'll see the Slido box. And we'd be happy to get to any and all of your questions here for the next hour while we have Ben with us. But with that, Ben, why don't you take it away?
Okay, well, thanks so much, Emily, and always a pleasure to be a part of the Signal. Lots of things happening, of course, especially over the last 30 days. We've got mathematically a contracting U.S. economy. We have got trade issues. Maybe the U.S. provided some kind of olive branch to China this week. There's no concrete confirmation of that. We got hints that we're working or close to a deal with India, but again, no concrete details surrounding that. So we're all just kind of waiting to see how this trade war, these trade negotiations evolve, but not a lot of real new evidence this week. Other than that, kind of prevailing themes is the dominant, I think, factor in the markets today. And those are three, we think. And so just jumping right in, the trade war, after everything has been sorted out, I think, from tariffs of 45% on East Asia to now just 10%. Reciprocation kind of across the world, and now there's very little retaliatory tariffs placed on the U.S. except from China. But that's kind of where we are. The administration, I think the U.S. and China are at war with each other. We're doing it through economic issues, but it's clearly because of China's kind of resurgence over the last 2 decades, and the U.S. trying to maintain dominance, and that's where we are. And that's, I think, the concern over the next 2, 5, 10 years. But just wanted to communicate that. After everything that's happened since about the early part of February, it is the U.S. against China. And that's, I think, how this thing evolves, at least through the rest of 2025. Second most important thing, though, and it's, I think, most important, is the world dairy markets are very tight. They're probably going to get tighter. And so fundamentally, I think both grains and dairy markets, for now at least, and this is odd given all the chaos we've seen the last couple of months, I think we are trading fundamentals. Today, there's a caveat to this that we'll discuss. I think the dairy markets and grain markets is trading supply and demand, and the tariffs aren't terribly relevant to price discovery, let's say, in the medium term. China's, of course, going to buy all of South American soybeans. They're not going to buy any from the U.S. And the risk there is that they probably can do something like contract farm soybeans in Brazil, but also Uruguay, Bolivia, Paraguay. So that's the risk to the soybean farmer in the U.S. But otherwise, there hasn't been a lot of retaliation again. So we're just kind of, grain flows are pretty normal. And I think dairy flows today, at least, are pretty normal. So it's all weather, it's all supply and demand. And so we're not negative dairy. That's, I think, the overarching message. I don't think we're going to see the heights that we've seen in the markets during summer and autumn the last 2 years. I think there may be upside to $20 class 3, not $24 class 3. But again, we're not negative dairy markets. And that's because the U.S. is very, very competitive. The most important thing we do kind of on a week-to-week basis or month-to-month basis is watch where do U.S. cash dairy prices exist relative to everywhere else. And those spreads are widening. They're not contracting. So I think there is upside potential to dairy disappearance despite all of the macro and policy issues we're facing. Feed market's kind of the opposite. If Mother Nature cooperates, we're going to have a swelling of, I think, at least corn and soybean inventories, maybe things like oats and potentially spring wheats. Again, if Mother Nature cooperates. We've talked about this, intermittently over the last year or so. We just don't see a global demand driver for the feed markets. A lot of the strength we have seen in corn, which is very valid, very rooted in fundamentals, has really been because of supply loss. A year ago, crippling drought in Ukraine, southern Russia, parts of Europe. Brazil's corn crop a year ago was a lot smaller than we all thought. And so everyone has had to be funneled to the U.S. market to buy corn and to some extent to buy soybeans. That kind of goes away if weather is normal during the rest of spring and into summer. So we think that, like most years, feed markets probably going to peak in the next 30 days. So if you're producing corn, keep that in mind. It is not remarkable for corn, soybeans, and wheat to break and break pretty considerably during the summer months if weather is good. That is very, very routine. I think we've got some runway, so we do like kind of forward hedging corn, soybean production on rallies. Same thing with milk. I do think we want to reward rallies in milk, but the seasonal trends are opposite. I think we have kind of the lows in the market have come and gone, which of course is pretty common in Q1. Net premium probably gets added in milk dairy markets for the rest of the calendar year, but it is corn, soybeans that I'm concerned about. If you see decent prices in the next couple of weeks, I think we want to at least pass some of this risk off on to someone else. So this is, I think, the context for policy. And of course, ag markets, most raw material markets, the number one thing by far is weather. A close second, I guess, is government policy. And then there are a lot of distant third, fourth, and fifth things that drive markets on a weekly, annual basis. But number two being policy. And I think this is what's driving things today. Kind of a dislocation of previous trade agreements, and that spans kind of across the world. I mean, what is a new world order going to look like? Or what's the attempt from China, from the US? And we're not really sure how this all gets sorted out, but this, I think, explains it. So it's the two largest economies fighting for dominance. And so I think we can expect both to kind of dig in their heels, at least for the foreseeable future. Without getting too esoteric here, I mean, a lot of this is going to be politics based. So I think both Xi and Trump have some runway politically until things get very bad to kind of dig into the trade war. $27 trillion in the US, 17 trillion or so in China. Who's going to be number one 2 decades from now, I think, is what we're fighting today. I'd also kind of highlight, I think China has plateaued for now. I mean, a lot of Chinese economic issues predate the trade war. And so the discrepancy between the US and China was getting wider, at least the last 24 months. But anyway, this is what we are. I think Germany, Japan, India, UK, Thailand, Vietnam, those are just collateral damage in the latter part of winter. It is clearly the US and China digging in for probably a protracted battle. The caveat that I mentioned too, the dairy outlook, is China is the largest dairy importer on earth. And I think the third largest market for the US. So number one is Mexico, two is Canada, number three is China. To date, Chinese imports of U.S. dairy products have been pretty routine. I mean, we'd never expected them to match sort of the massive tonnages of imports in 2023, but otherwise we've been above last year, at least the first 2 months of official data. Annually, and we like China to buy 550, 600,000 tons of U.S. dairy products, but all things considered, I think this is pretty normal. U.S. trade between U.S. dairy trade between China, at least as of today. The issue is that we're kind of hearing from some of our exporter friends that China probably is targeting exiting the U.S. market at some point. For how long, we don't know. I think what has been purchased will get shipped. I don't think we're going to see anything really special in U.S. trade data to China over the next 2 months, maybe 3 months. But there is a risk, and that is the caveat, that we do lose 30 to 35,000 tons of exports of China going away. And so I think you have to reshuffle this. I don't think China can go to Europe, especially Europe, and not even to New Zealand to source their dairy needs. But it is, there's going to be kind of casualties in this trade war. Is dairy one of them in the US? I think odds are low we see a material change, but due diligence, we did want to communicate. We're hearing not great things about Chinese interests in U.S. dairy products moving forward, and just wanted to highlight that they are the largest importer on earth and the third largest importer of U.S. dairy products. I think, too, the economic concerns are worth paying attention to, at least. This is going to be nuanced. We did see the U.S. GDP contract in Q1 for the first time since 2021, down 0.3%. I don't think that was terribly surprising. And in fact, relative to some previous estimates, is a lot better than expected. The Atlanta Fed's GDP Now product, which is just math-based, there's no sentiment in this. That model was kind of hinting that GDP would have been down up to 3% in Q1, and instead it was just, a couple of tenths of a percent. But it is contracting. We would like to see growth. On balance, all of this in the US and globally will impact food consumption growth. So in the ag space, kind of our priority is whatever it takes to get people to eat more food. This is going to be a hurdle to that, I think. Maybe not to specific products. Like a lot of dairy, I think, will be consumed, but generally speaking, I think a lot of high end, a lot of restaurant traffic probably will be curtailed by just people slowing down consumer spending. And we have been here really for the last several years, almost since COVID, I think, this imminent recession. That again, it takes 2 consecutive quarters to be mathematically in a recession. So we're not even there yet currently. But it's the kind of shape or the ebbing and flowing of unemployment that provides pretty decent guidance. And so Dr. Claudia Sahm, who coined the Sahm rule, which is very simple. When unemployment rises by half of 1% compared to the 12-month average, you tend to foreshadow recessions. And we've been here a couple of times in the last 6 months, but we are here again. So it's not so much that unemployment is high now. I think we're still very close to full employment, 4.2, 4.3% unemployment rate. It's not really an issue today, but it's just kind of how things bottom out, then tend to go up. That's just a concern of ours. Not that we want to be fear mongers here, but just kind of keeping in mind, I don't think we're going to see remarkable growth in things like restaurant demand, gasoline consumption, things like that. So that's kind of the state of the U.S. economy today. And we're just kind of keeping our eyes out, ears up on how things could get worse over the next 6 months or 12 months. So this, I think, is the biggest concern when we talk about trade wars. China was not expected to buy U.S. corn, U.S. soybeans. I don't think they can replace U.S. dairy, but it's the general impact of slowing global economic growth that I think is missing. If we want to be real bearish of U.S. ag markets, this is not the sort of landscape that you like to see. And China, the largest importer of most things, to be honest, there's 1 billion people within the country, so that all makes sense. Our purchasing power is down. I think, like I mentioned, this all kind of predates the battle of tariffs that started about January, February. So China, on the margin, can buy fewer tons of soybeans or non-fat dry at the same price they could a year ago. Things are getting more expensive in China to import, and that's because of currency. And this, again, predates winter 2025. This has been going on for a long time. So those are kind of the headwinds that we see. This, I think, more than anything, explains the dairy markets in the first quarter, and maybe not even that, but we are seeing sustained growth in U.S. milk output. So it's kind of collided. We've got trade policy uncertainty, probably a slowing U.S. global economy. And for the first time in a long time, we are having milk production growth in the United States. And mathematically, it's not, I think, nearly as worrisome in terms of oversupply as one might think. Again, this is just math. Production last February, for example, was very, very low. So to rebound, I think there was very low odds that we weren't going to rebound eventually, just because we were kind of in the doldrums in terms of national milk output. But we have seen 3 consecutive months of production growth. In March, 19.8 billion pounds. That was up 0.9% for the 3rd consecutive month. Kind of centered on cow herd growth as well. And really, to that point, Texas herd growth. In the last 4 months, the dairy cow herd's up 49,000 head. And so it's kind of flies in the face of what we've seen in terms of this incredibly strong beef market, live cattle market. In spite of that, we are seeing some stabilization of the breeding herd, more cows. And notice on the right, though, this is kind of seasonally normal as well. So our job is what's next to the markets. I don't think building the cow herd really tells us that much when you see it in Q1 or into maybe April or May. This is all kind of part and parcel of a normal evolution of the dairy space. But it is happening. We do have more milk than we had a year ago. Exports are on the margin down just a little bit. So you kind of seen supply stabilize, balance sheets loosen, markets corrected in Q1. That kind of explains where we were. The USDA has to move, something. They see the futures markets doing what they're doing. They had to lower cash prices, of course. That makes sense. They raised annual U.S. milk production to 226.9 billion pounds, up 700 million from their March outlook, or about 0.4%. So it's kind of in the eye of the beholder here. I think the thing we want to focus on, and I think this is why we are not negative of dairy, whether U.S. and especially in the global market. There's thinking about growth prior to about 2019. It was very, very consistent, 1% at least, up to 2.5%. This was pretty normal for the U.S. dairy market and for places like Europe and New Zealand. That has kind of ended. And so even if we debate whether production's up, 0.3% or 0.5% in 2025, it's not something that's going to trigger an oversupply of milk, especially when we have, of course, we all know, expanding cheese production capacity, which may give us more cheese, 6, 8, 12 months from now. But I think there's still going to be kind of a battle for raw milk supplies in the medium term. I think to be real bearish of milk, concerned about margins for a long period of time, you've got to see another 100,000 cows added to the herd. We've got to completely eliminate bird flu from the West Coast, and we've got to see an improvement in yield. I don't think any of that stuff really lies ahead, at least for this calendar year. So we think the USDA is about correct in its annual production forecast, which means you're growing. There's no doubt about that. That is important. But at the same time, you're kind of locked into not growing milk production very much. That's why I would say that sort of eliminates the odds of $22, $24 class 3 milk. But I do think that as the market moves along, we just produce less milk as the length of day increases. The upside could be $20. And so we would reward that rally. But again, I think we're not negative of milk prices today. I think when we kind of put the picture together, one of the things that we're concerned about, and this is just, arithmetic, is yield. And it's clear that we can grow the cow herd pretty easily in the first quarter of the calendar year, but yield's been something we really haven't been able to beat nationally, at least since 2021. We intermittently have seen periods of improvement, but it hasn't come on a lasting basis. And even in the last couple of months, it's growing the national milk yield, but it's not growing very much. I don't think we can say with certainty that we're going to continue growth, even slight growth, every month for the next 9 or 10 months. We will see. Yeah, we'll all stay tuned to the USDA's milk production reports and what yield is. But I think you got to see something way over 0.5% or even 1% to guarantee an oversupply of milk. And I don't think that's coming. So we kind of factored into our models, the seasonal trend in cow numbers, which have been growing, but also shrink, kind of May onwards. That's very, very normal. I think the beef cow market and the beef markets do, on balance, kind of limit expansion as well. There's no sign of real expansion there either. Record beef prices, record live cattle, feeder cattle prices. And if we kind of keep yield on a monthly basis, 0.2%, this is, I think, what it looks like for the rest of the year. So you're going to see growth of 0.9%, 1%, into June or July. Those milk reports are going to show us that. They're going to show us there's really no shortage of milk today. But again, just comparing to last year, it kind of falls off summer onward, and you're kind of down to 0.2, 0.3%. So again, this is a kind of long-winded, but to say we've solved the milk supply issue that we've seen in the last 4 years, I don't think we're quite there yet. And we're thinking maybe the USDA's annual forecast, while close, maybe 100 million, 200 million pounds too high. And a lot of it's going to depend on improving yield. And, we all know what's happening on the West Coast with avian influenza, but it's also kind of scattered around the country. And even Wisconsin, statewide at least, kind of stagnant. We're not seeing big growth there, or in New York, Illinois, Kansas. They're just kind of scattered states that just don't seem to be matching that, 1% year over year growth in milk yield. And so nationally, probably not going to have an oversupply of milk. So here's kind of where we are. This is the theory that we've floated during the sort of peak bearish sentiment of milk and dairy product markets over the last 2 or 3 months. Is it the loss of China? Is it the concern over food consumption? Are we in this kind of new era of declining demand? Or was it just unremarkable performance of the dairy markets? And so far, while butter has fallen from a very, very high price and has done little over the last several weeks, I think cheese class 3 are kind of starting to show us that that's all very normal. You break class 3 milk in Q1, almost year in and year out. Spring flush, none of this is insightful. We're going to peak U.S. milk production in the next couple of months, and then we're locked into declining milk supply availability, expanded cheese production, very good cheese export. So I think, but we're not going to see a rally in cheese of 20 or 30% between now and September, October. I think 8, 10%, 12% makes very good sense. I think the red line here will follow in cheese pretty closely the black dotted line. So there's upside, $1.95, $2 spot cheese. I think that's pretty reasonable for an upside target second half of summer. Just wanted to highlight that, again, so far, the weakness we haven't been really concerned about. And I think there's evidence growing to suggest it was just kind of a normal seasonal break. And when the USDA sees the futures markets doing what they're doing, they've had to react. There is no complaint there. When you see class three milk kind of every couple of days, at or below $17, 30 days ago, we had to lower the cash price forecast, and they did by 50 cents a hundredweight to $21.10. This is an annual average all milk cash price. We've seen this in the monthly data as well. So first wanted to say there's still this pretty sizable premium in cash milk compared to class three and class four. It's been kind of a new phenomenon we've seen since about COVID, maybe just before COVID. So you look at class three, you add $2 to $4 a hundredweight, that's going to be the statewide all milk cash price, as well as the national cash price. But we kind of did some work to see, does the USDA also kind of subject to the seasonal price error? We know that dairy markets are very weak, Jan to March, sometimes into April. It's typically the low of the market. What does the USDA's cash price forecast look like during those monthly reports? You can see here it's not every year, but in most years and pretty consistently, they are too low with their cash price forecast, just because they've got to account for the futures market or even the cash price of cheese or butter on February 15th or April 1st. And it's typically the lowest of the year. So I do think we won't see much excitement in USDA milk forecasts. I think they do get higher or stabilize here. I don't think there's a big risk that they get much lower, especially when you start to account for class three cheese, even butter, to some extent over the last couple of weeks in their May report. I don't think there's really any evidence to lower cash milk price forecast. So I think we're kind of locked into something like $21 a hundredweight, maybe 22 at the upper end of history. Feed costs should, I think, improve in the upper Midwest pretty easily if Mother Nature cooperates. So I think, again, we're kind of positive on the dairy space and even not negative of milk prices. We've broken through kind of what was major resistance. And again, this just kind of highlights just how pessimistic the market is in Q1 of any calendar year. Not very good at managing forward risk or forward potential, but we've seen that play out again. Similar to last year, though not as dramatic, and it won't be as dramatic for the next 8 or 9 months. But I think this is showing us that there's the too bearish in March and early April. We kind of found new equilibrium, which in the spot market we think is 18.5 to 19.5. Kind of the pre-February price range, I think, is fair value in class three with all the evidence that we have now, and that stays the case through the first half of summer. But the number one most important thing, we've highlighted this almost every 2 weeks on the signal, is the U.S. market does what it does. It's very volatile. There is some speculative component to this. Even the managed funds, we know, are very, very short class three for some reason or another, and that short position does tend to get covered, but they're active. The global market is less volatile, and the trend there is still pretty clear to us. So kind of moving higher slowly but steadily, 2 steps forward, 1 step back. As of late April, $1.99 per pound versus $1.93 per pound. In early April, that's the weighted average price of all products traded at the auction 2 weeks ago. This just doesn't seem like it's following the U.S. trend, but also suggesting that on balance, the global dairy market has been tight, stays tight, and we're getting a little concerned that it gets tighter because of what's happening in terms of shrinking cow numbers in Europe, which is the second largest exporter of dairy products on Earth. I think they're losing production very, very quickly. I think global dairy auction, global cash prices continue higher, and that's even seasonal in places like Europe and New Zealand. Butter, for example, tends to go higher every 2 weeks in Oceania between now and about September 1st. I think that probably continues. Cheese, new equilibrium at about $2.20 per pound. Butter is kind of flirting with all-time record prices. So butter 2 weeks ago at the auction was $3.48 per pound. In the U.S., it is about $2.30 to 35 cents per pound. It doesn't drive daily price discovery or even weekly price discovery, but we do think that the butter market's going to have to contend with net exports of something like 3 to 8 million pounds every month indefinitely at this point, I think. A year ago, we were a net importer of maybe 2 to 5 million pounds. So the balance sheet for butter over time, I think, does change. We always build butter stocks in the first half of the year, and there's really no exception to that. It's just very seasonal in nature, and it's going to happen for another 2 or 3 months. But I think the rate of increases in terms of butter inventories will be challenged by exports. This shows us that the butter market's now $1.10 to $1.40 per pound below everyone else. European butter is at $3.76 per pound currently, and it's kind of on its way to the all-time record of $4.25 that we saw the middle of last year. So does the market stays here, $1.50, 60 discount to Europe, and we're going to export a lot of it. And we're already seeing that play out. So I just wanted to show you that US butter is very cheap. Trade flows are changing. We have turned very quickly from a net importer of butter to a net exporter of butter. And today, even thinking about something like Kerrygold or even New Zealand butter does have a 10% tariff on it. So add that or something like that to the retail price at the grocery store. I think we're going to find the consumer is going to buy more US domestically produced butter, and we're also exporting. So I think the decline in butter stocks after June 30th will be accelerated by this. And whether it's corn or wheat or butter or milk, you never want to be terribly short the world's cheapest of anything, and that's what the US butter market is today. Cheese as well, not as exciting, but there is about a 60-cent premium in cheddar prices in Europe and New Zealand compared to the US block market today. And this works pretty well. So when we see very, very large discounts like we saw a year ago, we see a lot of export disappearance. And really, cheese exports have been about record high by pretty wide margins since February 2024. That probably continues. I mean, it will ebb and flow. I don't know if we're going to get to 55,000 tons exported in March or April, but I do think we're going to follow generally the trend of last year. Exports are going to be very, very strong. Again, thinking about someone like China, where there's 145% tariff on U.S. products. So I don't know if you can get it from New Zealand, given there's a 60-cent premium already in that market. You're kind of, even in the case of butter and some cheese varieties, offsetting the tariff cost, or at least a large part of it, just given current cash price spreads. So I think U.S. cheese, U.S. butter, very, very cheap. The discounts are widening. They're not contracting. So I think we're going to export a lot of this stuff through the rest of the calendar year. So we're kind of thinking about the forward market. I think demand for dairy in the U.S. is going to be very strong. And this is kind of the yin and yang of trade wars and trade policy. We do not like obstructions to global trade, but at the same time, the US dollar index has collapsed. Is the US a safe place to put your money in? That's something the bond market will determine over time. But we have become more competitive relative to the previous, 2 years or so, just based on US dollar weighted prices. So the US dollar index is stabilized, but still kind of flirting with a 4-year low today. That's kind of helped offset some of the issues that we're facing, and things like wheat, especially butter, cheese, even corn to some extent. Currencies in Brazil are getting stronger, the euro is getting stronger, and the US dollar is getting cheaper. So that helps, I think, keep some measure of import demand funneled to the US. So that's kind of the snapshot. The world market, very, very strong. US, very competitive. That's something that I think even the bears have to contend with. A lot of really, really strong export disappearance, into let's call it October, when Oceania milk production starts its seasonal rebound. But the forward market outlook test too is I think importers like China even are going to have to contend with an ever shrinking supply of milk relative to the last 12 months. So New Zealand, genetic issues, land issues. We've seen no herd growth there, but they did have a pretty decent 2024 in terms of milk output, but the rate of gains have been slowing. So New Zealand production in March officially was 1.8 million tons. That was up 0.6%, but that compares, to 5 and 7% in the early part of their season in 2024. So rate of gain slowing. In Europe, there's been a lot of highlights, in the markets this week about how small Europe's dairy herd is getting. I don't think, like in the US, there's a lot of evidence of any kind of breeding herd retention. This probably gets worse before it gets better, and also some yield issues colliding with this. So European production of milk in March was 13.7 million tons. That was down 4% from last year. So the whole pie is getting smaller. And if there's not a pretty significant disruption to global dairy consumption or dairy trade, I think the US is going to fill that hole being created by European milk declines. So this has been the case for the last couple of years. And one of the long-term theses in the U.S. dairy space is, probably over the next decade, global dairy consumption and trade are going to grow by the normal 0.5% to 2%. So you kind of add 5 or 7 million tons to trade and consumption between now and 2035 or so. I don't think Europe's going to fill it, and I don't think Oceania is going to fill that. So it's kind of the U.S. is where the burden exists. We've got to produce more, we've got to export more. Otherwise, dairy markets get very, very tight globally. But the message is European production is down and it's getting worse, and it probably doesn't recover at least through the end of summer. So our competing markets struggling with milk supplies and dairy production. And anyway, when we think about something like butter, we've only got official data for Australia through the end of February, but again, we're all kind of subject to daylight hours, seasons. Oceania milk production, the world's largest exporter of butter, and where prices are very high currently, are just for all intents and purposes not going to produce milk in June and July. So this kind of explains why I think the global butter price only gets higher over the next 3 or 4 months, just because we already don't have a lot of competition from Oceania. There's going to be even less as we get into the middle part of summer. So that's kind of the dairy snapshot. Is global market higher, U.S. production growing, but not by very much. And I don't think there's going to be a major disruption to total global demand, though there probably will be some reshuffling because of the U.S.-Chinese trade war. Feed markets, I think, too, the dairy operation, this is generally positive. We're all, at the mercy of Mother Nature, but we don't think that feed markets have a lot of upside after about June 1st, unless there's a Northern Hemisphere weather problem. So I think one thing that is giving us strength and kind of extends this runway for upside risk in a market like corn especially is we do not have a lot currently. U.S. in stocks, we think will be below 1.4 billion bushels, which relative to history, we've only been tighter than that in a handful of years over the last 4 decades. The exporter balance sheet, which we think really drives price, could be the tightest it has ever been. Since record keeping started in places like Ukraine, Brazil, the late 80s. So we've got to have favorable weather to build stocks. I think that we all need to be prepared, whether you're buying feed or you're producing corn. We've got to expect a pretty wide swinging market. It's not going to be structurally rooted in anything except for weather forecasts that are updated every 6 hours. But since we're not carrying over a lot of soybeans, certainly not carrying over a lot of corn, every forecast is going to matter. The market's perception of yield will determine whether we're tight or loose, on September 15th or November 1st. So there's this need for really, really strong, favorable weather from the US, Canada, Europe, Ukraine, and Russia. But if we do avoid issues, let us assume normalcy in terms of weather, then stocks building does become very likely because we can't identify a new demand driver. It's all been supply loss the last year. That's why corn is where it is. And so all of that gets eliminated if Ukraine does see normal rainfall and temperatures, or the same thing with Europe or Russia, and especially the Midwest United States. In longer term, I think the outlook for something like meal or soybeans, or for producing soybeans, I think that market has the biggest risk associated with this sort of changing world order. And the reason is, really just supply and demand fundamental, but there is land in South America that is not being farmed currently that can be used to grow soybeans. And so if it gets bad, if we don't sort out our issues with China, I think that market will supply, China first, and then the rest of Southeast Asia with their import needs, just because they can grow more soybeans, starting next year in places like Paraguay and Brazil and Uruguay, maybe Bolivia as well. So the loss of market share is a concern for soybeans. Not as much for corn or wheat. I think we're kind of out of places to grow corn very well and to grow wheat very well, but it's the soy complex, I think, that struggles, and that includes meal. If you loosen up South American soybean balance sheets even more, Argentina has even more room to crush and export meal, and we're kind of stuck with oversupply. And here's where we are. I think, again, the old crop corn market gets very, very tight. There's a lot of numbers here, but sort of the gist is we think that feed use will be lowered. Just what we've seen in the data the last couple of quarters. But there's probably room to grow ethanol disappearance by 25 million bushels, and we are a full 100 million bushels above the USDA with our export forecast. Today, and really between now and August 1st, there's not many places to buy corn, maybe Argentina, but not Brazil and not Ukraine. So if anyone needs corn, Mexico, the Caribbean, Latin America, Western Europe, I think you've got to buy it from the US. 1.39 billion bushel carryover. Again, historically very, very tight. But the sort of core of the issue moving forward is really just that the US farmer intended to plant just over 95 million acres. Based on planting progress to date, the forecast acreage does change. We think it'll get a little higher, not lower. So we're using today a 96 million acre planted figure, assuming trend yield stocks are up by almost a billion bushels. And that assumes only kind of modest demand contraction. It's just the additional acres, maybe crossing that 180 bushel per acre yield threshold. Just this is the math that plays out. Weather is going to be a risk. We'll kind of touch on some issues that we're seeing, but the other side of this too is that you got to get pretty low in your perceived yield or actual yield to have a real supply problem again in corn. And again, that is mostly just because we're planting so many acres this year. So if we assume yields 175, that would be kind of the low end of the last 5 or 6 years. So you're still at 1.7 billion bushel in stocks, which is not bearish December corn here, but I don't think it's bullish at 460 or 470 either. Harvest pressure, that still exists even if you've got a yield of 175. So our work, and we can't rule this out. This is going to be something that the market will sort out as we get into the heart of the growing season. But probably a sub 170 yield, whether real or perceived, is what gives the corn market some legs. So if you're a producer, keep this in mind. The market may add substantial weather premium in any given week in June or July, but the actual yield has to be very, very low to, I think, be bullish of corn on a lasting basis. So reward those rallies. Sell and defend is kind of our mentality. I mean, if we are in a scenario that the probable yield's 165, I will work our way out of these positions. But for now, it just has to be pretty dire in the Midwest to tighten the U.S. corn balance sheet in 25, 26. Soybeans are a little different. We have become pretty pessimistic on exports after about August or September, and that's just because we see, one, China's economy before the trade war not doing great. We don't see a lot of growth in their need for soybeans or crush or meal just because the hog market's still pretty deflated there. So if you kind of sort out the pie, assume some expansion in South America, the number that falls to the end of the trade matrix is about 1.6 billion bushels, and that's down 250 from what we think it's going to be this year. So you're at about 500 million bushel in stocks. That's about a $10 market, in perpetuity. But we've lost a lot of soybean acres. So if yields 50 or 49 and a half, we are contracting the soybean balance sheet. So I think expect more fireworks in the soy complex short term, if you do have some growing issues in the United States or perceived issues based on weather forecast. And soy meal today, again, the longer term, I think we probably do get to 250 if South America avoids problems and the U.S. avoids problems weather-wise this summer. But the ratio to milk to protein meals very, very wide. I mean, we do generally like protein meal prices where they exist today. And I think just it's very hard to be bearish of soybean meal below something like $280 a ton. The market's kind of lost its bearish enthusiasm once we've gotten to those levels the last couple of months. And I think that still continues. So we have no problem with it. Any point you'll lose $5 or $10 in soybean meal. Why not add to coverage? Just kind of pass that risk off on to someone else. And for now, kind of the seasonal trends that are locked in things like butter production or milk production, dairy prices, we're going to be crushing fewer soybeans, at least for the next, 6 months or so. And that's always the case, but I do think you're going to lose some amount of meal production between now and August. So what's the next story to the downside? And protein meal, maybe it gets very bearish kind of October onwards, but between now and then, I don't think there's a lot of evidence to support much lower soybean meal prices. And corn, this is kind of how we think it shakes out. So again, whether you're on the production side or on the buying side, I think these seasonal trends tend to work. I mean, the precision can get you in trouble, but we think the price action really since harvest has been unremarkable. It has been intense at times, but it's really been following what normally happens every year between August 1st and so far, the opening day of May. We've got probably another month's runway. How tight does the old crop U.S. corn balance sheet get? Do we still sell to most importing countries? Are we at least, will the market perceive something like 1.3 billion bushel in stocks? Will there be an early season kind of summer weather threat? I don't know. But after about Father's Day, if there's not just, clear, dire Midwest drought, the market tends to break kind of year in, year out. And we've also about that time got to contend with Brazil's winter harvest. So we're kind of the list of reasons to be bearish of corn midsummer onward is growing. It's not getting smaller. I think the first hurdle, and we've kind of seen that in the market this week as well, is it's going to be a pretty chaotic weather pattern, especially across the southern plains. We are concerned about excess water, flooding, tornadoes in Kansas and Oklahoma. But for the heart of the Corn Belt, it's going to be pretty warm, too hot in some places, between now and the middle of May. Not going to rain that much. I think this crop's going to go in the ground pretty quick. And so it's just the first box you can check off. There's many things that determine corn yield, but I think over the last 4 or 5 decades, if the crop is planted, 80% of it is planted nationally prior to May 20th. Odds that its seeding date that limits yield potential is pretty low, and I think we're going to get to that pretty easily. So I think this is the first hurdle the market's got to contend with. A lot of new corn acres, and this crop will be in the ground. If not early, I think within optimal windows. So it's kind of the forward outlook. Even Wisconsin, I think we're going to be able to get this stuff going prior to May 15th or 20th, no problem. And talking about the seasonal trend and the list of reasons that corn may have to deal with something like oversupply second half of 2025 is, to us, what is new, one, we're getting the crop in pretty fast in the U.S., but also it's Brazil. The monsoon there found this second life about April 10th. Rained in abundance, and it kind of went against a lot of the short and long-term climate forecasts in Brazil. But you can see here that this is April 1st to 30th. Percent of normal rainfall. The winter corn belt is highlighted. 200 to 400% of normal rainfall. So they've got subsoil moisture to carry them through pollination. The wet season ends in May 1st, but we're always debating whether that corn crop is 85 bushels an acre or 105 bushels an acre. It is not precision agriculture here. They just throw the seed on the ground. It's their second crop. It's planted right after soybeans. And so I do think we'll be able to get 100 bushels an acre based on it's raining in abundance and more than we all thought in the month of April. And that's when pollination tends to start if corn was planted there in the month of February. And we will jump into the weeds a little bit, but this is important, I think, to the corn market, especially if you're a producer, and thinking about forward purchases, which we would hold off on, maybe until July, August. This shows the seasonal evolution of rainfall in Mato Grosso, Brazil, which accounts for pretty routinely about half of Brazil's winter corn crop. CONAB, the Brazilian government today, is projecting the winter corn yield in Mato Grosso about 6% below trend. But on the right, you see if we just kind of align April rainfall and Mato Grosso's corn yield performance, it does look like the Brazilian government's too low. So rainfall in April by itself could add about 80 or 90 million bushels to Brazilian corn production. So we're already kind of starting to see higher Brazilian corn estimates. And I think those make good sense. It just rained a lot exactly when it was supposed to, and that's going to carry them through the pollination period. And again, needing 100, 105 bushel an acre yield should be pretty easy at this point. So there's going to be about 230 million bushels or so more Brazilian corn available in August and September that was not available last year. The U.S. has dominated corn exports because we're the only country with a large surplus. Again, low Brazilian production last year, terrible drought in Ukraine and Russia. So we were the market that the importers were forced to buy from. It's probably starting to change a little bit. So we've got to entertain kind of a different rate of corn disappearance in the 25-26 crop year. This is where we think the Brazilian corn exports will be up about 6 million tons from last year. Ukraine and Russia, it's too early to tell. It is actually very, very dry there now. There are some bullseye targets placed on this region for summer drought, but we will cross that bridge July 1st. If the pattern does change and we assume normalcy weather-wise and trend yields, combined exports of corn from Ukraine and Russia will be up 7 million tons. And so we put the two together, assuming normal weather. Russia, Ukraine, Brazil will have 500 million bushels more to export between August and December. That didn't exist last year. So there's going to be competition for exports. So again, this is different than what we've seen the last 6 months in the corn market. And it's already starting to play out. So you can kind of see here the FOB premiums of the major exporters. This is the basis above or below the Board of Trade that importers pay for supply. One, Ukraine has no corn left. If you want to buy corn from Ukraine, you have to pay $1.55 over the Board of Trade today. But Brazil, starting to weaken, starting to compete. I think they're getting more comfortable with a large production, and that harvest will start middle of June. They're probably going to start selling corn for July and August delivery, I think, in the next couple of weeks. That's not something we've seen for the last 3 months. So just be prepared for more competition. And so this is kind of what it looks like visually. So again, incredibly tight old crop stocks, but this ballooning of stocks next year if Mother Nature cooperates, or if we get something like a 178 to 179 yield, we just, because of the area being planted this year, the corn market does look like it changes quite a bit. And even our price models would say that while the old crop market, because we sold a lot of corn at harvest, is pretty cheap compared to stocks to use. If we think, again, assuming 180 or so national corn yield, stocks to use in the US jumps out to 15%. That is a 370 to 385 market, season average cash price to us. So there is premium in December corn. We've started to shed some of it based on planting dates, and the forecast looks fairly benign for the most part in most places. We're not going to shed all that premium until we get to the 4th of July or so. But I think if you kind of start checking these boxes off in terms of supply threats, you will every month kind of stair step down in the price of corn. So again, thinking about if you're a producer, runway's getting short, I think, to hedge forward. But if you're a buyer, I don't think there's a lot of urgency to hedge second half of 2025 just yet. We would only do that on breaks and corrections. Planting pace two kind of colliding with, it's been intense, but drought erosion. So today, drought only covers 20% of the U.S. Corn Belt. A week ago, it was 26%, and probably next week it's down to 17 or 18%. Kind of a routine drought coverage scenario, at least over the last couple of years. And the speed at which it has been eroding has been pretty impressive. You can see here on the right, this is just the 1 week change. It's been very wet in the northern plains and in Iowa, even Kansas, Oklahoma. So, the area of drought coverage, water availability concerns are getting smaller. They're not getting larger. Here's the one caveat to this, and I want to be clear, I don't think the market will trade this until it happens. Our confidence in these being exactly correct are pretty low, but again, intellectual integrity, we have to show you what a lot of people think about forward US weather. And so it kind of jumps out to us, and these are updated, every day. So we just see how these evolves. We will revisit this in the Dairy Signal, a month and 2 months from now. On the left is NOAA's kind of probability forecast. So the probability of exceeding a certain threshold, and this is below normal rainfall between June and August. It's in Nebraska, Iowa, really west of the Mississippi. And it's the shading of this map, I think, that we're paying attention to at least, or at least it's something that'll be part of our routine daily, starting, June 1st. NOAA is pretty confident that there's going to be drought in the Central Plains and Western Corn Belt. And again, I do not expect the corn market to digest any of this until it happens, especially given how wet it's been and the odds that more rain falls in a lot of places over the next 10 days. Drought's going to get smaller than it is today. But NOAA, again, confident that there's going to be some issues. And on the right is the climate scientist that we work with. It kind of mirrors this, kind of a probable dry west of the Mississippi this summer. So just wanted to kind of again, we'll revisit this 30 days from now. If we do see spikes in corn and soybeans, we will have known why. But for now, I'd say we'll just stay tuned 2 weeks, 4 weeks. We will just see what these maps look like. The other issue, and I think this does kind of benefit corn disappearance at least, as well as cheese, is Mexico, after solving some drought issues second half of summer, autumn last year, it is back. And it's pretty expansive and it's getting bigger pretty fast. On the left, you've got current drought conditions in Mexico. This really covers almost the entirety of corn production areas. And on the right, you've got the 10-day forecast, which it's going to be like it has been. It's going to be 85 to 90 degrees every day. And it's not going to rain really at all in Mexican agricultural areas. So, they've got until June to plant corn, but I think if this continues, you probably do have to assume Mexico is going to stay the largest importer of corn. That will be our market. And it's going to be growing by 2 or 3 million tons if you do lose yield in Mexico. And so the associated issues with milk production, the need for cheese, all that keeps Mexico, I think, a very, very big market. So we are watching Mexican drought pretty closely. So again, a lot going on, but the message is, not negative. Dairy markets, feed markets are going to be volatile, but we think there's a lot of evidence to support lower corn price the second half of this year. And I think the geopolitical headlines will continue to come pretty fast and loose indefinitely. So questions now or at any point in the future, if you have questions about risk management, our email address is here. We'd be happy to help. Just reach out. So thank you for your time.
Well, thank you very much, Ben, for all of those insights. They're always greatly appreciated. We have had a few questions come in, so I'll just start at the top and read down. The first question, from an economist perspective, do we need to enhance the cow diet more to meet the rapid improvement in genetics from genomics? Have the cows hit the glass ceiling?
A really good question. I think the detailed work that I have seen is the answer is no. But I mean, we can all talk about components as well. So, outright volumes of milk, and I think volume of milk is very important. But components are kind of offsetting some of this. We still need more. But it doesn't seem like that is the case. I think it's just the spread of maximizing production efficiency. I'm talking to you guys who the best dairy producers on earth. But I think it's just how widespread is this idea of maximizing the gene of the dairy cow, and I don't think that's as widespread as many people think. But I guess to the short-winded answer here is I don't think so, but the national numbers I think does seem like we are at some kind of glass ceiling. And if you're not focused on, maximizing the genetics potential of the cow, then we're just at a very high yield already in the US. And so growing that will be difficult, I think, on a national basis.
All right, thank you. On the next one, what are the long-term effects of a trade war with China?
The long-term effects, I think the biggest concern that we've got is economic growth. So I think it's going to be challenging for the two largest economies on earth to really have a lot of growth. And it's again, I think this is to think about this, we're kind of thinking about it through the lens of war. There's going to be some casualties, and I think one of those will be economic growth. So paying more for things on both sides of the trade war, and just kind of the being forced to resort market ideas is going to kind of hinder certainty, hinder growth. That's, I think, the number one thing. The second thing, I think, and since it is with China specifically, other countries may be collateral damage, is it's the soybean market. And again, like I mentioned, the biggest risk here is just fundamental. There's land in South America that can grow soybeans pretty well. It's not being produced because they don't have the incentive. But if the trade war continues, the price of soybeans in Brazil is going to go up quite a bit. Then you have the incentive. Then they're going to grow more soybeans, and we're probably not going to get that market share back unless there is just pretty crippling drought in Argentina and Brazil. So two things. One, global economic growth will be curtailed because of the trade war. And number two, soybeans, just more is going to be produced in South America.
All right. And finally, you mentioned consumer spending slowing down. How long do you anticipate this for?
I think for a while. I mean, I think we've got to have some kind of clarity over policy. And again, we're kind of waiting on negotiations, something to suggest this is all settling out. Outside of China, I don't think that's going to be sorted out in 2025. But we need something, I think, some measure of certainty. Otherwise, you're kind of looking at private, public sector layoffs. And, we don't kind of think about going through that yourself. I mean, you're going to change your spending habits. You're not going to go on vacations. You're not going to get out as much. So I don't really see an end to that until there's a lot more clarity or stability in the financial markets. So that's, I think, going to be a concern for the rest of the year.
All right. Well, thank you very much, Ben, again for your time. It's always a pleasure. I want to say thank you to everyone for joining us here today on the Dairy Signal, as well as a special thank you to our national partners who are with us year in and year out and make programs like the Dairy Signal possible. To learn about our national partners, as well as all of dairy's premier suppliers, head on over to PDP Prime on our website. I hope you have a wonderful rest of your first day of May here today. A wonderful weekend, and we look forward to seeing you back here on the Dairy Signal next week. Bye now.